Good afternoon and welcome to this SW Financial Reporting webinar. From wherever you're joining us in Australia, you're all very welcome. My name is Tom Malarkey. I'm a partner at SW and I'll be moderating today's session. Firstly, I'd like to acknowledge the traditional custodians throughout Australia and their connection to land, sea and community, and pay our respects to their elders past, present and emerging. Now, I've been joined today by some of my colleagues throughout the SW National Practice who will be presenting with me today. We've got a newcomer to our list, Mark Smith, and he's going to be first up, and he's going to be talking about the lessons learned from the June reporting period just gone, and he'll be looking forward to the December reporting period. I'm joined by Bessie and Jimmy, who are regular contributors. Bessie is going to talk about ASIC enforcement actions and issues, and Jimmy will talk about accounting standard changes which you need to be aware of. I'll round out today's session and I'll talk about sustainability reporting, which is a hot topic at the moment. In terms of housekeeping, please enter or click on the enter full screen button at the top right hand corner of your screen for the best webinar experience. We do have a Q&A running throughout the session, so there's a Q&A function at the bottom of your screen. If you click on that, type in your question. We'll endeavour to answer your question either during the session, during the Q&A at the end of the presentation of the webinar if we've got time, or otherwise if we need a bit more detail, we're happy to touch base with you after the webinar to get more detail and attempt to answer your question then. We will be circulating the slides after this presentation. Also, now in terms of polling questions, we've got 2 questions today. The first one should be popping up on your screen just about now, and it relates to a question that relates to Bessie's session, and she'll talk to that later on in the session. And with that, I'm going to introduce Mark. So we're delighted to have Mark on board. He's recently joined us. He's got 11 years experience in accounting in the accounting industry, has comprehensive experience in interpreting and applying Australian accounting standards and international financial reporting standards. Additionally, he has lectured on financial accounting and reporting at Deakin University. He's delivered both internal and external training on various financial accounting and reporting topics. Mark has a strong problem-solving ability and provides pragmatic solutions to complex accounting issues. He has a passion for learning and development, takes pride in helping his clients improve their financial accounting knowledge, which aims to serve them best in making decisions that impact their business. So with that, I'll hand you over to Mark, and you're welcome. Looking forward to your presentation.
Thank you very, very much for that introduction, Tom. And yeah, welcome everybody. Hello, I'm very, very excited to be here. This is my first webinar with SW, so I'm very, very excited to be here. So let me get straight into it then. So it's fair to say that there haven't been that many new developments with regards to financial reporting. We've been hit over the last year or two with a massive wave of new developments, and now it seems to be a bit of a quieter period, so to speak. But in saying that, though, there still never is a dull moment in financial reporting. There have been a few things that have been happening behind the scenes that I think it's very, very important for everybody to be aware of. So let's get straight into it. I thought a very good idea would be to have a look at what potentially has been on ASIC's surveillance. You know, what have ASIC been focusing on? What have they been looking at? And I know over time we always speak about what are the main ASIC focus areas. And just to give everybody a bit of an update about this, so ASIC would you know, at the end of every reporting season, they like to do a review of a lot of listed entities. They'll pick and choose a few listed entities that they go and have a look at their financial statements and want to see whether or not these entities are compliant with the Australian accounting standards and the Corporations Act. And having a look so far at what their main focus areas have been on and what they've been picking up on and what they've been calling out with a lot of entities is the following 3 things, right? So the first one, obviously nothing new to a lot of people, is impairment. Like I said, it's always at the top of ASIC's focus areas. But I think more so now than ever with the current economic climate, impairment has become a really key focus area. And what I mean by that is obviously when ASIC is reviewing financial statements and having a look at them, they are obviously looking at the assumptions that are being used in determining the recoverable amount when it comes to impairment testing. And like I said, right now with the current economic climate, we got rising inflation, we got increase in interest rates. I think entities and preparers of financial reports need to be very careful and be very focused in terms of what their assumptions are, and being able to support those assumptions and make sure that those assumptions are reasonable. So when I'm talking about assumptions, like I said, I've got a few examples. I'm talking about the assumptions that go into your cash flow projections, such as your growth rates, your terminal growth rates, as well as your discount rates. As you can imagine, right, current rise in inflation and increase, like I said, in interest rates, that will have an impact if you are calculating cash flows and you're looking at the discount impact of future cash flows, right? An increase in the interest rate would most likely mean an increase in your discount rate, which would most likely mean that you will have a smaller net present value potentially than what you would have had in previous years, right? My advice always to preparers and those preparing impairment calculations is just once you've done it, because I know a lot of the time you get stuck very much in the detail, but what I always advise whenever I review a set of financial statements as well is just take a step back. Take a step back and look at the overall picture. Look at what the assumptions that you've put down on a piece of paper actually mean in the greater context of your financial statement. So when I review financial statements, I review from the top and read right through. And sometimes when I get to the disclosure surrounding impairment, I sometimes question, whether that actually makes sense. And you can easily pick up sometimes when those assumptions are not reasonable. And that is what ASIC is picking up on. That is what they are looking for. And I think what will probably happen going forward is there are going to be situations where some entities that need to obviously recognize some impairment, haven't been doing it in the past, are probably going to now be required to have some form of impairment and recognize some form of impairment. So that is just, again, a really key area of focus that we keep talking about. But like I said, ASIC is actually picking up on a lot of these things. The next one is also one that they've been talking about for quite some time. And like I said, through their surveillance program now recently for the 30 June reporting season, they've actually made some entities change things in their financial statements. And that has got to do with the disclosure surrounding material business risks and how entities are actually implementing strategies to mitigate those risks. Specifically, when I'm talking about where to disclose these, I'm talking about in the operating and financial review section of the financial statements. So usually at the top in the beginning, like I said, looking at the whole picture, entities are really now needing to actually think really hard about those material business risks that have an impact on the future financial prospects of their organization. And they need to be disclosing these business risks. They need to also be disclosing, like I said, what strategies are they putting in place to actually mitigate these risks. And I've just listed out a few examples here of what we would expect to be seeing, taking into account the current economic climate that we're living in. So like we said, it's been around in the news recently, very much so. Cybersecurity threats, ability to raise potential capital within the organization, availability of labor, as well as any climate risks as well. If these are risks that are impacting your business and would have an impact on the future financial prospects, I suggest you start including disclosures surrounding these things in your financial statements. Now, again, I'm talking mainly about your listed entities or any significant entities whose financial statements are out there for public view and are open there for the public forum. They got to start thinking very clearly about what disclosures they're putting in their financial statements surrounding business risks. Like I said, it's been a focus area. It's been talked about a lot, but now's the time where you actually got to start implementing. And then the last thing that's been caught up with ASIC surveillance at the moment is the use of non-IFRS information in financial reports. Now, this is something that I think, like I said, I review quite a lot of financial statements, and I've actually been picking this up more and more when I'm reviewing financial statements. So what does this actually mean? It basically, most organizations internally might have their own way of presenting the performance of the organization. So they might have a different way of actually showing how well the entity performs. So like I said, they might start with a profit figure that is being determined through the application of the Australian accounting standards, but then they might adjust this figure. They might take out non-recurring items or one-off items to actually present internally for their organization what is a true reflection of performance for the organization. But what entities need to be very careful about is disclosing this non-IFRS information in their financial report. So what they like to do is in the director's report, again, is potentially actually They might quote this figure, they might show this figure, you know, to explain how well the entity performed. And the issue with this is that it can be quite misleading to the users of the financial statements. If we are starting to refer to we use different names or different terminologies, like I said, that is probably different to how it would be presented if we were purely basing this on the Australian accounting standard. So again, just something to be mindful of. Like I said, as I review more and more financial statements, I am picking this up more and more, and I'm having to go back to the preparer saying, hold on a second, you've got to be very careful, because these figures that you are quoting here are actually quite misleading, right? And if you are going to quote it, you've got to explain how you got there. You've got to explain the differences in how you potentially got to that profit figure. Right. What has been keeping me busy? Like I said, it's been a quieter period from the perspective of no new developments, but as always, there's never a dull day when it comes to financial reporting. There's always things happening, and these are a lot. I basically had to go back and think quite hard over probably the last 6 months, you know, what has been keeping me busy, right? And this is just a bit of a snapshot. As you can see, the major thing there again is impairment. Right. So I would say probably over the last 6 months for the 30 June reporting season, as well as now looking forward to the 31 December reporting season. I think in the past, entities that have had goodwill or other indefinite intangible assets whereby they have to do a test on an annual basis for impairment, and maybe in the past there's been a lot of headroom. They've coming to realize right now when doing the test that, like I said, with the increase in rates, with the increase in inflation, they've had to really think about the assumptions that are going into their cash flow forecast, and that headroom has become less and less, right? And this now makes sensitivity and looking at changes in growth rates and changes in assumptions, what impact that will have in your impairment. It's put the spotlight on having a look at those, like I said, those real, you know, assumptions that could go either way, depending on like I said, whether your growth rate might increase by 1 or 2%, what impact that might have on your calculation. Like I said, the headroom has become smaller, and now entities really need to be focusing on this. Furthermore, like I said, fair value measurement, this sometimes goes quite hand in hand, like I said, with impairment, because if you think about determining your recoverable amount for impairment, sometimes you need to think about what the fair value less cost to sell is, right? But I'm also talking there specifically, what has kept me busy is situations where entities have assets that actually are carried at fair value and not at historical cost on their balance sheet at the end of the year, and thinking about what approach we're going to be taking to determining the fair value. I get a lot of questions. People come to me and ask, how do we determine fair value? Where do I start? I know the standard says I need to determine fair value, or that this needs to be recognized at fair value at the end of the year, but I don't know where to start. And that's why I put that AASB 13 is your starting point. That gives you the go, that gives you the little push start to say, okay, what approach am I going to take here when it comes to determining fair value? Other things that have been keeping me busy, business combinations. As you can see there, like I said, I like, you know, when reading through these purchase and sale agreements, I think what I sometimes find people miss or don't think about what impact it could have on the overall business combination accounting is where there are contingent payments, and specifically earnout payments. Like I said, just be very mindful now if you're dealing with this leading up to your 31 December reporting period. Just be very mindful to be looking out for these specific type of clauses, because they will have an impact on how you account for the business combination, as well as things such as puts and call options, right? Quite technical, but again, I've come across a few of these over the past few months, where again, there might be a clause in there that gives the buyer the right to acquire the remaining non-controlling interest, or it might give the seller the right to sell the remaining non-controlling interest. Again, there's a very, very complex and might have an impact on how you account for the overall business combination. So just be very mindful when reading through agreements and looking out for these specific clauses. And then the usual suspects, as always, share-based payments have been keeping me very busy lately, and specifically when it comes to assessment of vesting and non-vesting conditions. It's always a question that we need to understand first and foremost. What are the vesting conditions? Are there any conditions? And again, are they vesting? Are they non-vesting? Because they will have an impact on how the whole share-based payment arrangement could be accounted for. And for those of you that are probably looking quite closely at my slide, you might question, you know, what I've got on there, looking at limited and non-recourse loans versus recourse loans, and thinking, what has that got to do with share-based payments? Yes, you might have been thinking, hold on, loans, that should be, that should be sitting under AASB 9, and isn't that a financial instrument? No, again, I have been dealing probably over the last 6 months with a lot of these situations where employers and employees enter into arrangements whereby employers will obviously grant loans to employees to purchase shares in their organization at a later date if they meet certain conditions. But depending on the terms and conditions, and that's where you really got to look at the terms and conditions and spend some time in understanding them, depending on the terms and conditions, that might actually in substance look like a share-based payment arrangement. So again, things that have caught a few people out over the last 6 months that I just wanted to make everybody aware of. And then revenue seems to be popping up its head quite a lot, ASB 15, and obviously this principal versus agent consideration, that probably has been keeping me busy the most probably over the last month or so. So again, just looking at there is clear guidance in ASB 15. If you look at your paragraph B35 to B37, there is really good guidance there that you need to apply. But that is something that I've noticed more and more, perhaps more so than when the standard first came out. People are obviously having to actually look at that guidance and try and apply that guidance. And then leases. So again, leases, fairly recently new standard. We probably had about 2 years now of implementing the new standard. And I think what a lot of the questions that we are getting now is obviously since the standard since the standard was released and since the standard was implemented, there had been a lot of questions about how to implement the standard. And now the questions are about, okay, we've come to the end of our lease term, we're renegotiating lease terms, or we're reducing the lease term, so modifications to the original provisions of the contract. How do we account for any modifications to the original provisions? And then something that is, again, probably in the last six months or so, is sublease arrangements. I think are becoming a lot more common again, perhaps with the current economic climate. And how do we account for these sublease arrangements? So that is just a snapshot, I would say, of what has been keeping myself busy, what has been keeping ASIC busy, and what have they been focusing on. Then, as I mentioned, never a dull day. I thought it's worth mentioning something that happened roughly, I would say, during the 30 June reporting season, busy season, that caught a lot of people by surprise. So this was something that came completely out of the blue, was obviously the removal of the relief for previous grandfathered proprietary companies from having to lodge their financial statements. So if you recall, I think this dates back way before my time, before I even set foot on the shores of Australia. But there were a group of proprietary companies that if they followed certain criteria, they were actually granted relief from having to lodge their financial statements. So they still had to prepare their financial statements, they still had to get these financial statements audited, but they didn't have to lodge them. So they never became open to the public, and they were literally just shelved or put in a cupboard and used for internal purposes. And there's been a lot of questions, when is this ever going to be removed? When is this relief ever going to be removed? And then it finally snuck in on the 10th of August, right? The Senate introduced an amendment to a Treasury bill that basically removed this relief, right? So where it did become quite complex was looking at, like I said, for years ending on or after 10th of August. So this impacted any of these grandfathered proprietary companies for years ending, financial years ending after 10th of August. They no longer have this relief from having to lodge their financials, but it did become quite complex because those grandfathered entities that had a 30 June 2022 year end that were thinking about using the extension granted by ASIC for preparing and having their financial statements audited were kind of caught out by this a little bit in saying that if they were going to utilize that extension, they were actually going to have to lodge their 30 June 22 financial statement. So just be mindful. I know October's gone, but we're still in November. If you have always been a grandfathered proprietary company and you haven't yet prepared your financial statements and had them audited yet, and you are in the process of doing so by the end of 30 November, you unfortunately are still going to have to lodge your 30 June 22 financial statement. So just be mindful of that. And then this is great. So like I said, this has probably been, again, on the agenda for quite some time by the AASB, and we've all been waiting. So like I said, we've had the wave of the removal of special purpose financial statements for the for-profit private sector entities, and we've been waiting for the not-for-profit private sector entity to see what's going to be happening in that space. And the AASB has recently released their discussion paper on this new Tier 3 accounting framework for not-for-profit private sector entities. So that is currently open for discussion, and I think we have 6 months. So I know the AASB is encouraging people to have a look at this, have their say, give their commentary on what this is going to entail. And like I said, so the AASB are basically thinking about creating a separate tier or another tier. So we know we have our tier 1 and our tier 2 currently, and they want to create another tier, a tier 3 for your not-for-profit private sector entity. So essentially what this could mean is if you are a not-for-profit entity that is still preparing special purpose financial statements, what could happen in the future is that depending on what the regulators say, who's in scope of having to apply this new tier 3, you might have to in future be preparing your financial statements under this new tier 3 that is being proposed. And that is going to be a completely separate new standard that has recognition and measurement criteria as well as disclosure criteria. So what I would like to say to everybody is just watch the space. I think as this develops more and more, and as it goes from a discussion paper into something more concrete, we will obviously give you more guidance on this going forward. But that is just a very, very short snapshot of what's been happening in the technical accounting space from my end.
Thank you very much, Mark, for some of that very relevant content there. Albeit not too many new developments, like you said, the old reliables are keeping you busy. And certainly what we're seeing so far is, like you said, headroom is being squeezed in those impairment calculations. So thank you for that, Mark.
No problem.
Now we're going to, our next presenter is Bessie Jung. She's a partner in our audit division. Now, before you get started, Bessie, I do have the polling responses that you may be interested in. So the responses are to the first question, 74% of our attendees have not heard of NoClair. So that sounds like you've picked a good topic and a very relevant topic, Bessie. So with that, I'll hand over to you.
Thank you very much, Tom. That's the answer I expected, actually. Let's talk about NoClair in a couple of minutes. Hi, everyone. Nice to see you here. Even though I can't see any participant, but I know you do exist. I have a big number online. So ASIC released its enforcement priorities for 2023 early this month. We picked a few main points and we'll go through by some examples shortly. Worth to mention here is that this is the first time ASIC has identified particular areas of enforcement focus, and it will continue to do so on an annual basis. Let's start with ASIC's enforcement action against auditors as an audit partner, and why relevant to you as our clients or potential clients, because management and directors of companies would likely to be charged in the first place for every case against auditors. So please help us by providing your true and complete information on a timely basis and discuss with us about how to remedy the situation. The increased ASIC enforcement actions against auditors was built up from the well-known Central Property case, where $1.1 billion bridging facility to be refinanced was classified as non-current debt. So PwC was to pay $66 million, and the audit partner had 2 years suspension plus an enforceable undertaking, which means a binding agreement between ASIC and the contravention party about the remedy actions. So Corporations Act 307A, which any contravention under this clause is a criminal offense, requires auditors conduct the audit or review in accordance with the auditing standard. Then the second step, the auditing standard 102 requires auditors to comply with the accounting professional and applicable standard, the APES. The third step, APES requires auditors to assess suspected non-compliance with laws and regulations. This is our beloved NoClair, which is the points bracket A, B, and C. So if you read through it, you see it's not only about your financial statements, it's about everything, including your operations, your business, employees and management, and those charged with governance, and the third parties under your control. So they are all within the assessing and reporting scope of external audit. I hope you're not overwhelmed. So here are some practical examples of NOCLA that your auditor needs to assess and report, like fraud, money laundering, terrorist financing, securities market and trading, data protection, environmental protection, public health and safety. Okay, apart from NOCLA, we have another Bible, the RG, Regulatory Guide 34. So auditors' obligations on reporting to ASIC. We need to report any suspected significant contravention, as well as not a significant contravention, but the matter will not be adequately dealt with by commenting on it in the auditor's report or bringing it to the attention of the directors. There are some common suspected contraventions that are likely to be significant, which means your auditor will need to report to ASIC. Otherwise, they might lose their licenses, including the common ones, modified audit and review reports, non-launchment of financial reports, ongoing failures to comply with a compliance plan. For example, your audit reports have been modified continuously for the same matters. So we need to do something about it. Let's have a look at a couple of recent criminal charge cases. So GT audits of I signed this. It's about failure to disclose approximately $3 million in revenue that was one-off and non-recurring, and failure to disclose one-off costs. You'd imagine the net impact to P&L might not be that large, but still they're charged with conviction. But they do have a potential NOCLA issue for money laundering as well. Second, Rothsay audit of Big One. It's about conflict of interest, material misstatement. Audited financial statement showed a cash balance of $9.2 million, but actually it's only less than 1 million. So no sufficient audit evidence in file. The third one is a financial service company with the financial service license, AFSL. The auditor failed to understand Halifax business and didn't conduct effective audit. And worth to mention that this is the first time in Australia for an audit partner to be charged with criminal conviction. The last criminal case for today is about share price manipulation with maximum sentence of 10 years imprisonment. Next, let's quickly talk about ASIC's focus on the financial institutions. The three examples on this page are all about bank misleading customers and overcharging. These three examples are about financial institutions failed to provide the services for the fees they charged, similar to the last page. So if you think you haven't been mistreated by your financial service provider, the banks, like myself, it's time for us to review our statements and make some inquiries. This case is talking about the AFSL holders do have the obligation of managing your cybersecurity risks and make sure sensitive customer information is protected. This is a very interesting one to notice. The energy company has some false or misleading disclosures on their sustainability related statements. We call it greenwashing. It's not about the financial statements. It's not about the director's report. It's the sustainability statement. So ASIC has expanded the review scope. So energy companies should pay attention to your sustainability issues and disclosures. The last page in relation to ASIC enforcement actions are about listed companies misleading and deceptive representations about crypto assets. and other continuous disclosure obligations. So listed companies should have a system to monitor these compliance risks. That's it for my part. Sorry for not expanding every case, but only the ones that I am interested. If you need the details, you can always come back to the slides or reach out to the SW team.
Thank you for that, Bessie. As a fellow auditor, I'm as concerned as you are with some of the enforcement actions taken against auditors. And I do like your comment around greenwashing. Yes, that is becoming a more relevant topic. So thank you, Bessie. And with that, I will hand over to my colleague, Jimmy Chow. He's going to take you through accounting standard changes. Away you go, Jimmy.
Thank you, Tom. So I'm going to give you the information about the accounting standard that's going to be effective first time for the 31st December reporting seasons, and also look a little bit beyond to see what's coming after this year's. So as Mark has mentioned before, that's not a lot of things happening in the accounting, but as you can see from the slides, this year the blockbuster is absolute removal of the special purpose financial statement. And you can see from the number of accounting standard that's being put out there, that's quite a heavy topic. And that's going to be first time effective for the 31st December year-end entities. So in addition to that, there's another annual improvement projects that's coming to effective this year. I will pick a few more relevant pieces to dive into a little bit detailed. So removal of special purpose financial statement, this has been in the topics for more than 2, I think possibly 3 years. We know it's coming and it's finally here. So for those entity has a June year end, they have now already goes through the process or maybe in the midst of finalizing their June financial statement, they are already moved into general purpose financial statement. So just a very high level introductions. So for this year, if you are December year end, you will be required to do a set of general purpose financial statement if you are in one of these two camps. The first one is if there is a legislative requirement for you to prepare a set of accounts under Australia accounting standard. So we are talking about if you are a large proprietary company, if you are a subsidiary of a foreign-owned companies, or if you hold the AFSL license, so you will be required to produce a set of general purpose financial statements. Although there is some transition relief that's for AFSL license holder, we're not going to talk too much about this today. So also, if you are after the first camp of legislative requirement, if you have a document that require you to produce a set of accounts in accordance with Australia accounting standard. So the document can be a trustee, a partnership agreement, those constitutional document, or even a bank loan agreement. If the agreement asks you to produce a set of accounts in accordance with Australia accounting standard, and if this agreement or if this document is created after 1st July 21, so anything before, you kind of still being grandfathered. So I use grandfather words, but this is very different from what Mark just talked about. So if you are captured under this category, you also need to prepare a set of general set of accounts. And there is additional disclosure requirement if you are utilizing the general the grandfathering rules. So we have done a quite detailed webinar for an hour-long webinar. So if you want to get into a little bit more detail, understanding what exactly is the requirement, we will include a link to the webinar. So together with the removal of special purpose accounts requirement, there's a new tier of disclosure called simplified disclosure being introduced. So that's the new tier 2 disclosure. So comparing to what people normally have with a special set of accounts, with the new simplified disclosure, that's a significant difference. So I listed a couple of the big ticket items here on the list just to give you an idea what are some of those differences. So the important one, revenue. So now you need to produce a lot more information in your note of accounts in relation to the revenue. You need to give the breakdown. You need to talk about your performance obligations. So that's a lot of information there. Tax is another big area. Now you are required to show tax reconciliations. Take your profit before tax times 30% or whatever your tax rate is, and then reconcile back to your eventual tax expense number. So that's a tax rec. It's required under the simplified disclosure. Also, deferred tax. What's your deferred tax reconciliation? You also need to disclose those. Related party disclosure, always important if you're doing a general purpose set of accounts. You need to talk about your parent company, the transactions with different related parties, and also your key management personnel compensation will also be captured under related party transaction disclosure. And in general, you will have a lot more other disclosures, and you will have reconciliations from your opening to the closing, what's happening during the year for your PP&E, for your provisions. And also just a gentle reminder, all your disclosure for this year is going to be applicable for the comparative. So you do need to go back to December 21 to produce those informations. So as I mentioned before, there is some additional disclosure requirement if you fall under the categories that utilizing the grandfathering rules. So you are required to disclose a whole lot of information. Some of those you might already been doing, you might already putting those in the financial statement, but there's one particular one I want to draw your attention. So that is, if you are claiming in compliance with Australia accounting standard, but in fact you have accounting policy that's deviated from the Australia accounting standard in terms of measurement and recognition, you are actually required now to disclose those impacts, to describe exactly how you are not in compliance with those accounting standards. So that can be a quite tricky one if you are not currently doing all your recognition measurement requirements. So one example can be you treat every of your convertible instruments as equity, your redeemable preference share as equity, but if you were to follow accounting standard, you will have to look into splitting those into equity or liabilities. So just a quick reminder, this is a very recent accounting standard being introduced. I believe it's introduced about 2-3 months ago. It is also effective for any entities that's doing June 2022 financial statement. So it may already be effective when you're currently producing a set of accounts. So I'm not sure if Mark is still here. Yeah, I just want to ask you, in your review of the financial statement or in your dealing with the technical issues, have you heard a lot in this topic? I want to see your view.
Yep, no, very good question, Jimmy. So if I'm very honest, there was a lot of noise surrounding this, like you said, when it first came out. And I was sitting probably a year ago thinking, gosh, that it was quite quiet for the 30 June 2021 period. So I thought, okay, everybody's probably leaving this till the last minute. They're not going to take, the benefits of all the exemptions that were granted for early adoption. And I was expecting for this period that it would be a lot busier, but it actually has been quite quiet. And I'm actually quite glad that you've gone back to actually just have a look again at who is in scope, because like I said, I was expecting a lot more questions to be popping up. I was expecting to be reviewing a lot more financial statements that have transitioned and didn't get the benefits. Like I said, the exemption benefits that were previously given to you if you early adopted, but it has been fairly quiet. And I think when I sit in sometimes over year conversations, it seems to me as if people are still trying to figure out whether they are in scope or they don't clearly understand the scoping requirements. So I'm very glad, like I said, that you've gone over that again, Jimmy, to make sure, because I think the first thing a lot of people still think that this impacts any entity. So I get questions coming my way. I've got a not-for-profit entity and I have to stop them first and foremost and say, hold on, this is only for certain for-profit sector entities, for-profit private sector entities. And then there has been the removal of the previous reduced disclosure regime. So it has impacted some not-for-profit entities. But like I said, I still get questions about whether the entities are in scope or not. I do suspect, obviously, where there has been a lot more noise and why it's probably been a bit quiet in respect is obviously for AFSL holders, like you did mention, and that has been covered off quite recently as well. I think that's where a lot of the noise has been generated. But I do suspect now, with what you're talking about with this amendment, with the additional disclosure required for these specific entities that are, like you were mentioning, have been grandfathered, I think this will impact quite a lot of entities. Because when I have been looking at documents that state that entities have a requirement to prepare their financial statements in accordance with Australian accounting standards, I have noticed that a lot of them predated the 1 July 2021 period. So they weren't brought in scope, but now they obviously now need to have these disclosure requirements. Sorry. So I'm suspecting more and more questions, hopefully, to come out in relation to this. So yeah, very, very good question, Jimmy.
Thank you, Mark. Yes, I can absolutely echo your view. So we do have a lot of conversations, and sometimes I will take a step back saying, hey, do you actually understand what we're talking here? So it is a complex topic, so do feel free to come to us to bounce some idea. So now we have talked about the blockbuster, and let's look into some smaller standard that's also going to have some impact for the 31st December reporting entities. So included here, it's an annual improvement project. So the annual improvement is basically a big patch to the various accounting standards. Some of those are a bit editorial, some of those are just trying to make things consistent. So there is two particular standards that being impacted by this annual improvement. I would like to just shout out a little bit. So first one is on the PP&E. So what's to do with PP&E? This amendment is to do with if there is any sales, if you are preparing a PP&E and you produce some product and you happen to sell those products. So what to do with the sales proceeds? So currently there's inconsistency in the market. Some people do take that into their sales. Some people say, because I'm doing my PPE installation, so that's kind of just to reduce my capex. So there is inconsistency in the market practice. The accounting, this amendment just basically make it consistent, saying everything goes to P&L. And the second one is to do with provision, specifically on provision for loss-making contracts. You're required to book that into your liability. But how do you measure that? How do you come up with a number to be booking the provisions? So the accounting standards say now you need to include anything that's directly related to the contracts, and those can be your material, labor costs, directly attributed to fulfilling the contract. In addition to that, you also need to bring in your allocated overhead, your depreciations, your office admin expense that's directly attributable to delivering the contract. You will also need to capture a bit more of the expense when you are doing the provisions. So I have talked to you about what's happening this year, what's happening first time for the 31st December entity. Let's look into a bit further beyond what's happening in the future. So I list down a couple of new accounting standards that's coming to effect from next year onwards. I will deep dive into two of these. So the first one is to do with classifications of liability into current and non-current. So that's really just a very good extension from what Bessie has just mentioned. There was actually a legal case against the auditor and the directors in relation to this particular method. If you are classifying the liability into wrong category, you absolutely give a wrong status, that's so critical to the financial position of the company. So that's very important. So liability can be classified as a non-current liability if the entity has the right to defer the settlement of the liability for at least 12 months. And you will need to have the right to defer, and also the right need to exist at the reporting date. These are two very critical criteria. So under the old standard, they did say for the right to defer the settlement, that right need to be unconditional. And the accounting standard does now recognize this is quite difficult to do, how is unconditional right to defer. So now they have changed it to say, if the right have substance, you are then consider you have the right. And then obviously you will consider that there will be more judgment and estimate involved when you are actually thinking which right has substance. So, and also you will need to have the right at the end of the reporting period. What does it mean? It's eventually just means you need to be in compliance with your loan covenant. So you need to be compliant with your loan covenant at the reporting date. So that's in the old standard. But in the new standard, they actually have some additional requirement. If you need to be in compliance with certain loan covenant in the future, there are some additional disclosure requirement that's only recently being introduced. So what hasn't changed? So the management intention to refinance the debt in the next 12 months. If you have that, you still don't take that into considerations when you classify a liability into current and non-current. So a director may just, the management or director may say, oh, we know this loan is due next year, but we are now in advanced discussions with the banks to make sure they will roll over the loan. So that intention alone will not be able to satisfy to make the liability into non-current. So Mark, can I also call you out again? So I understand for this particular standard, there's a lot of back and forth from the accounting standard board. There was new thing issue, got pushed back and then reissued. Tell us a little bit more. And also for a normal company, what do you actually need to do? It looks like quite far away down the road.
Yeah, you're 100% correct, Jimmy. So this has been a bit of a moving target for a while now. And for those of you that have been keeping an eye on this, the effective date keeps changing and keeps moving. And I think fairly recently, the IASB, the International Accounting Standards Board, just finalized their amendment, specifically when it comes to how this is going to impact entities that have loan covenants. So what I'm suggesting right now, because like I said, the effective date has moved, but if, you know, I'm advising a lot of people right now that do have loan covenants that they need to meet, that do have really complex, you know, debt arrangements such as convertible debt arrangements, this is probably going to impact them quite a bit. So my advice to anybody is start having a look at those, you know, start having a look at your loan covenants, start having a look at your convertible note arrangements, start thinking about how this would impact, because yes, it's only effective later down the line and you can early adopt it right now. But if you decide to push it down the road, which is what a lot of entities do, they decide to deal with it at a later stage, there is going to be retrospective restatement. So you'll have to go and retrospectively apply this, which means you'll have to go back and restate things. So just like I said, moving target is very, very new. And as we, you know, in future, we'll probably give you a lot more guidance as this has been firmed up as well by the AASB. But for now, just be aware of it. Just start having a look at what impact this could have for you if you have, like I said, convertible note debt arrangements as well as loan covenants, because it's probably more likely that it's going to impact you the most.
Yeah, thanks, Mark. Very well said. All right. The other one I would like to draw your attention that's coming on your way is about the accounting policy. A lot of time when you pick up a set of accounts, half of the page is those accounting policies. And now the new requirements basically say, hey, you start to do some decluttering of those accounting policy. Just keep the material one, keep the one that's impact the storytelling of your companies. As you can see, ASIC has been very active in this space as well. They're looking into disclosure. They're looking into what are the risks being put out there. So I absolutely think if you you do need to spend a bit time just looking to accounting policy and determine which one is material. So with that, I'm passing back to Tom.
Thank you very much, Jimmy, for that update and that contribution from Mark also. So we are going to be pushed a little bit for time, so I might have to scoot through this section a little bit quicker than I had intended. And before I start, I think we're going to launch a polling question, which relates to the topic we're about to discuss. And it's really just to get a sense of where everybody is in terms of their sustainability journey. Now, as I mentioned at the top, very topical issue. There's been a lot of developments in this area over the last year or so. So it's a relevant topic at the moment, and it's important for everybody on this call to start to come to grips with it. So most of you will have heard of sustainability, but I'd be surprised if most of you all had the same idea of what it is. It tends to mean different things to different people in different industries. So there's a lot of confusion out there in terms of what it is. So today's session hopefully might clarify it a little bit for you in terms of what it is. Now, how has it arisen? So it's really as a result of last 10, 15 years or so. There's been a lot of external pressure from external stakeholders on businesses to operate in a sustainable manner. So it's no longer acceptable to be purely profit money orientated. You need to be able to demonstrate you're a good corporate citizen, you're impacting the world in a positive way, leaving the world in a better place in which you found it. You know, you got the younger generation, very climate focused, you know, focused on ethically sourced products and services. And we have also got investors, and I'll touch a little bit on investors later. So whatever you think about climate change, whatever you think about the youngsters and the notions and ideas they may have, I think sustainability is something that's here. It's here to stay, and it's something, as I said, you'll need to get to grips with. Now, if you've been to any business conferences, industry conferences over the last number of years, you'll have seen sustainability would be discussed, and it's gradually gone from being, you know, the event, the panel at the end of the event, you know, at the graveyard session, has gradually become more central to discussions, and it's really got a turbo boost this time last year as part of the climate change conference over in Glasgow, COP26. So that's the conference where Scott Morrison, he committed to net zero, but there was also some major developments from an external reporting perspective. So there was a new body set up called the International Sustainability Board. They're tasked with creating a suite of standards that will provide a global baseline for reporting on a sustainability perspective. Bessie did touch on in our session earlier on the concept of greenwashing. So this is something that's now on ASIC's radar as well. So that adds an additional kind of imperative for everybody to get across this. So I'll give just a brief bit of background. So you'll hear sustainability, ESG used interchangeably, but ESG broadly, E stands for environment. You know, what impact are you having on the environment you operate, climate, emissions, you know, impact on natural resources and natural capital and so on. The S stands for social. You know, what are the impact you have on the people in which you engage with as a business every day? You know, your employees, your customers, suppliers, and so on. The impact you have on the community in which you operate. And the G stands for governance. What are the policies and procedures we have in place to make sure that we are good corporate citizens, that we are environmentally responsible, that we are socially responsible? So there's a lot of frameworks in place that are out there, but broadly speaking, they all tie through to this, those three kind of concepts. Over time, you've heard of integrated reporting, triple line. You know, corporate social responsibility is a major kind of a focus now for businesses. I'll skip through this, but in essence, the new standards are drafted from an investor perspective. You know, what would an investor who's investing into new business, what would they expect to see? Because nowadays, you know, investors have certain, you know, values and ethics, and they need their investments to align with that. So they're divesting from old polluting industries, gambling, and so on, and they're investing now in enterprises that do good, that have, you know, a positive impact on the environment and the society around them. So up on your screen now, we've got the alphabet soup. So in response to this demand for sustainability reporting, you had a smorgasbord of different frameworks have built up, numerous different metrics applied. So there's a lot of confusion, no consistency, no comparability whatsoever. So in response, we've set up the sustainability board. And as I said, it's going to create a suite of standards that all entities with time will need to report towards. And they've come up with 2 standards, which I'll run through quickly. So you've got your S1 standard. This is the general requirements to report your sustainability information. So it talks in terms of enterprise value. So this is important from an investor perspective. Your enterprise value, it's not just the internal cash flows, it's the impact you have in society, on the environment, how that flows back into the cash flows that ultimately form the base of the valuation of the business. So it performs a holistic view of enterprise value to investors and the users of these reports. Materiality is important, so it's a similar concept to financial reporting, outlined in WSB 101, 108. What are the significant items you need to report on? And significant, think in terms of what are you already reporting on? Talks in terms of risks and opportunities. So what are the risks? And there are opportunities. So you'll see this new products emerging all the time. You know, we've seen the impossible meats and so on and so forth. So there might be opportunities to grow enterprise value as a result of sustainability. And some of the core contents and themes are around governance, as I mentioned earlier. Do you have a committee, sustainability officer, so on? Is it part of your strategy? Do you actually call it out as something that's, you know, embedded in the business plans and strategy? Have you got risk management processes in place to identify what these risks and opportunities are and report as required? And then where the rubber really hits the road, what are the metrics and targets you're using to demonstrate that you're mitigating risks, that you're reducing risks, and so on? There's also some general requirements, the reporting entity. So with time, you know, BHP produces a financial report. It's also producing a sustainability report. It's the same reporting entity concept. Now, the second standard that was released, so we've got the general requirements. Now, over time, there'll be a whole suite of standards issued on a particular topic. And the first one that has been issued is around climate, obviously a very important topic. Based on the Task Force for Climate Change and SASB reports or frameworks. So they're pre-existing frameworks, widely adopted already. So they'll use those as the framework or for the basis for producing this standard. Talks in terms of physical risks, you know, are you subject to flood, drought? Are you living in a coastal region, so on and so forth? What are those physical risks in the environment in which you operate? Have you got transition risks? And as I mentioned, other opportunities here. So can you adopt some new tech, improve your efficiency, and so on? There's other, you know, disclosures required from the standard: greenhouse gas emissions, carbon reduction initiatives, carbon offsets, so on and so forth. There's an additional layer. So in addition to all that, there are specific requirements per industry. So whatever industry in, mining, resources, agribusiness, there's a whole other layer of requirements that those entities and those particular entities or industries need to comply with. Now, they are designed to align with financial statement disclosures as well. So there is a connection. Some of your ESG related risks can impact ultimately the recognition and measurement of amounts in your financial statements. I've reproduced, there's a task force on climate change. I've got a nice diagram which kind of represents this diagrammatically. And there is a bulletin which was recently issued by ASB and the Australian Audited Standards Board that helps you apply materiality when you're thinking of putting in climate related or ESG related risks into your financial report. There is the obligation there. Now, I do know the WSB, they have set up a task force recently because they expect to see more climate related disclosures in their financial report, but there aren't any. So they want to know, why is this? Because you can imagine there are certain balances that are impacted, impairment, so on and so forth. Now, I have talked about greenwashing a little bit, so it is a focus for ASIC. So we've run out of time. I will say we will be running some sessions on this particular topic next year, full sessions, possibly even 2. So keep that on your radar. We will respond to you. I think we'll probably wrap up. I don't think we've got time for Q&A now. We're nearly at up to time. So we will endeavor to revert to anybody who has asked a question today, get back to you. I would like to thank all our presenters who have presented today, Bessie, Jimmy, and Mark. You did a great job, Mark. Stellar debut. Delighted to have you on board. And with that, I'll probably close out the webinar, and delighted that you were able to join us all.
Thank you.